A mother's selfish love, an incident sparks outrage among the Chinese public. Luxury industry in China slows down, Gucci's recovery more challenging. China's worst capital outflow in years exacerbates yuan woes. China dumps U.S. debt as Japan, other countries bolster Treasury securities. It's all covered in today's China Truths. A mother's selfish love, an incident sparks outrage among the Chinese public. At the 2023 Tour of Guangxi Road Cycling World Tour, a mother watching the race saw a rider giving a cup to the child next to her. She immediately took it away and put it in her son's hand. At that time, a foreign rider came over on a bicycle, and many people were asking for the cup in his hand, wanting to keep it as a souvenir. Finally, the rider chose a child in black, gave him the cup, and then rode away. Suddenly, a woman wearing a sun hat grabbed the cup from the child's hand, put it in her son's hand, and touched her son's head. She seemed to feel at ease with everything, and felt that this thing should be her son, not ashamed of her behavior at all. She would probably never have imagined that her shameless behavior would be photographed and posted online, and it caused public outrage. Many people have accused the mother of immoral behavior, some even scolded the mother that she lost her sense of being a human being. From the video, the mother was quickly recognized by other parents at her son's school. A parent group decided to remove her from the group due to her poor performance. Her approach meant that her son might be targeted and ridiculed by other students in the class. Judging from the woman's dress and his son's clothes, the family should be wealthy. Some netizens said that ordinary parents don't dare to grab things directly from other people's hands. Parents with quality will never grab things if they are disappointed. Many netizens questioned what kind of children can be expected from such a greedy and selfish mother. Even if they have excellent grades, their moral character will not be too high. A child who grows up in a selfish environment will not have a high personal moral character. Maternal love is great, but love also has standards and bottom lines. It cannot be based on the pain of others. Parents are their children's best teachers. So some complained that, with such a greedy, selfish, and profit-seeking mother, can her boy have a future? Luxury industry in China slows down, Gucci's recovery more challenging. After Beijing lifted its COVID-19 restrictions in December last year, it triggered a consumption boom at the beginning of this year. Luxury goods executives expressed optimism that China's rebound in consumption would lead to strong sales of high-priced handbags, jewelry, and other luxury goods this year. However, these expectations did not materialize. According to the latest update from the Epoch Times, sales at the French luxury goods giant Kering may slow down again in the third quarter. The group is attempting to revive its star brand, Gucci, under new creative direction, but the luxury goods industry is showing signs of declining demand, posing challenges to Gucci's recovery. TD Cowen analysts have revised Kering Group's third-quarter sales forecast, lowering it from the original year-on-year growth of 0.3% to a year-on-year decline of 7.7%. The turbulent economic outlook complicates Kering's efforts to revive Gucci's sales, a brand that accounted for more than half of the group's total sales and nearly two-thirds of its profits last year. Gucci was once one of the most successful brands in the luxury goods industry. Sales doubled between 2015 and 2019 to nearly €10 billion, $11 billion, but are now losing ground to rivals such as LVMH, Dior, and Louis Vuitton. Gucci's new designer, Sabato de Sarno, introduced the brand's aesthetic reset at his first fashion show in Milan in September, presenting it in a sensual, simple style. The new styles mark de Sarno's departure from the eccentric, gender-fluid designs of his predecessor, Alessandro Michele. Gucci's new styles won't be available until the end of the year. De Sarno's new designs received positive feedback in the days following the September show, but JP Morgan noted that online interest soon fell to pre-show levels. JP Morgan believes this change may take time to bring about. Meanwhile, a recent sales update from rival LVMH showed consumer demand for high-end fashion also declining from its post-COVID-19 pandemic peak. Shoppers in Europe and the United States are cutting back on high-end spending, while record youth unemployment and a real estate crisis in China, which has hit China's main growth engine, a sharp drop in exports, and difficulties for young people in finding jobs, have prompted Chinese consumers to focus more on savings rather than consumption. This has made the performance of the luxury goods industry in China more challenging. Economists say worsening structural problems may make it difficult for China to sustain its period of rapid growth, which has made it the world's largest luxury goods market. Investors' concerns about Chinese consumption have led to a decline in the share prices of luxury goods companies. Last month, Kering shares fell about 9%, LVMH shares dropped 7%, and Hermes shares fell 4.5%. China's worst capital outflow in years exacerbates yuan woes. China is grappling with the largest capital flight in years, raising concerns for authorities as Beijing exerts additional pressure on the yuan, which is already under strain due to a widening Sino-US yield gap and mounting concerns about the Middle East crisis. Goldman Sachs's preferred gauge of foreign exchange flows report published on October 20 showed capital outflows from China surged to $75 billion in September, the highest monthly amount since 2016, compared to the $42 billion outflows in August. This increase occurred despite smaller outflows by the foreign portfolio investment channel, it added. The Goldman Sachs's note said, foreign investors' net selling of equities and bonds slowed, but the current account showed net outflows in September on the back of faster services trade outflows, lower goods trade-related inflows and higher income and transfer outflows. According to Goldman Sachs's Stock Connect, the outflow was $12 billion compared to $22 billion outflows in August. In September, foreigners purchased $2 billion in domestic bonds, reversing the previous 2 months' selling. The exodus pushed the yuan well past its daily trading limit, with onshore spot yuan trading at around 7.32 to the dollar at midday on Monday at the Shanghai currency market. The Chinese currency at the day's close, however, was 1.93% weaker, close to the 2% limit, as the People's Bank of China, PBOC, maintained the guiding rate at 7.18 per US dollar with a strong fixing bias. Sugandha Sachdeva, executive director and chief strategist at the London-based Acme Investment Advisors, said, this persistent weakness in the Chinese yuan can be attributed to several factors. For starters, the strength of the US dollar, supported by the country's robust economic data, has been a key driver. Meanwhile, the other drivers are the geopolitical tensions in the Middle East and a sustained increase in US Treasury yields, which are currently at multi-decade highs. More than 1,400 people were killed and 4,834 injured in Israel since Hamas launched a surprise attack on Israel on October 7. Hamas also took over 200 hostages, including U.S. citizens and other foreigners. In retaliation, Israel has aimed its airstrikes at Hamas targets in Gaza and imposed a complete siege, cutting off the food, water, and fuel that it had voluntarily supplied into Gaza prior to the October 7 attack, until Hamas frees all hostages. She said, these factors are attracting investors seeking the safety of the U.S. dollar, which is exerting downward pressure on the yuan. According to Reuters, the spread between 10-year Treasury yields in the United States and China increased to more than 226 basis points on Monday, the widest in more than 2 decades. Ms. Sachdeva said, moreover, concerns surrounding the Chinese real estate sector, a narrowing current account surplus, and the differing monetary policies of the U.S. and Chinese central banks have all contributed to the depreciation of the yuan, all of which have created a challenging environment for the currency. According to Goldman Sachs data, despite a large trade surplus, China's current account showed net outflows month-on-month despite the elevated goods trade surplus. September's net inflow was $15 billion, lower than the $26 billion in August. According to Goldman Sachs's foreign exchange flows report, the services trade deficit widened to $15 billion from $14 billion in August, while the income and transfers account showed outflows of $7 billion in September, faster than the $5 billion outflows in August. Faltering economy. The capital flight also comes as Beijing risks missing its 5% growth target for the year due to a sluggish economy. The most recent data from the National Bureau of Statistics, (NBS), revealed that growth in the world's second-largest economy slowed to 4.9% on the year in the July-September period, down from 6.3% the previous quarter. The NBS also warned that the external environment was growing more complex and grave and that domestic demand was still insufficient. After nearly 3 years of zero-COVID restrictions, China opened its economy in late 2022, providing an instant boost early this year as more people rushed to stores and eateries. However, the post-pandemic rush suddenly stalled soon after, and earlier than anticipated, as analysts predicted that growth would likely fall to 4.5% in 2023. Consequently, according to data issued on Friday by China Central Depository and Clearing Co., foreign funds reduced their holdings of Chinese sovereign bonds by 13.5 billion yuan, about $1.85 billion, in September. Their entire debt holding fell to 2.07 trillion yuan, the lowest since March 2021. The depletion of China's foreign exchange (FX) reserve also took its toll. According to Goldman Sachs' analysis, the official FX reserve, released earlier in the month, declined to $3,115 billion in September from $3,160 billion in August. The report said, by our estimate, the FX valuation effects would have cut FX reserves by $28 billion in September, but after adjustments, FX reserves still decreased by $17 billion in August. The sharp moves by U.S. bond yields likely lowered FX reserves as well. Propping up yuan. Chinese regulators are trying to talk up the yuan. Over the weekend, for example, PBOC Governor Pan Gongsheng stated that China would minimize risk contagion in stock, bond, and foreign exchange markets, as well as guarantee financial market stability. Besides, Goldman Sachs added, China's central bank is also maintaining a strengthening bias in the daily yuan-to-dollar fixing rate, keeping the US yuan rate around 7.30 for the past 1.5 months. Ms. Sachdeva said, in response to China's challenges, it is anticipated that the PBOC will intensify its efforts in the foreign exchange markets to stabilize the yuan and prevent a disorderly depreciation. Still, analysts say that given the significant outflows, having dropped more than 5.5% against the dollar and emerging as one of the worst-performing currencies in Asia this year, the yuan will almost certainly continue to devalue against the dollar in the coming months. Ms. Sachdeva said, we reckon that the range of 7.40 yuan to 7.50 yuan per dollar represents a significant support level for the currency. Only if this support is breached, we may witness a substantial depreciation. Goldman Sachs said it will maintain its year-end yuan projection of 7.30 yuan per dollar on the back of Beijing's efforts to restrict the currency's slide. Overall, Ms. Sachdeva concluded that box actions and market dynamics will play a crucial role in determining the future trajectory of the yuan. China dumps U.S. debt as Japan, other countries bolster Treasury securities. According to new data from the Treasury Department, foreign holdings of U.S. Treasury securities rose in August, for the third consecutive month, to their highest level since December 2021. However, China captured attention by continuing to dump vast amounts of U.S. assets. Total holdings of U.S. debt increased nearly 3% year-over-year to $7.707 trillion. That was also up from the $7.655 trillion in July. China reduced its holdings by more than $16 billion to $805.4 billion. That's down by about 15% from the year-earlier period and the lowest since 2009. Chinese investors also offloaded about $5.1 billion in U.S. stocks in August, the highest on record. Japan maintained its status as the world's largest foreign holder of treasuries, with investors in Tokyo raising their stakes by about $4 billion to $1.116 trillion. Other notable countries to bolster their holdings were the UK, $36 billion, Canada, $1.2 billion, and Saudi Arabia, $3 billion. Nations that trimmed their holdings included Belgium, $2 billion, Switzerland, $18 billion, Taiwan, $2 billion, and India, $600 million. The long goodbye. Market observers contend that China sold its U.S. debt and equity holdings to support the Chinese yuan for intervention purposes. Beijing officials have reportedly pushed state-run banks to resuscitate the yuan. When that becomes the mandate, the regime sells dollar-denominated assets and uses the returns to purchase the yuan. This year, the onshore and offshore yuan have weakened considerably against the dollar, hitting the lowest level since late 2007. In 2023, the yuan has been one of the worst-performing Asian currencies, tumbling by about 6%. Other economic experts argue that Beijing is attempting to rein in its finances during below-trend growth. As a result, officials might be using the government's resources to prop up the world's second-largest economy. In the third quarter, China's economy slowed to a 4.9% growth rate. While that lagged the second quarter's 6.3%, it topped the 4.4% consensus estimate. Diversification is another critical component of China's war chest, with U.S. government debt representing about 1/4 of its total foreign exchange reserves, down from 59% nearly a decade ago. Beijing has been stockpiling a wide range of assets, from gold to crude oil to euros. Nevertheless, some economists refer to China's gradual dumping of U.S. assets as the long goodbye. BM Capital Markets chief economist Douglas Porter wrote in a note, after peaking above $1.3 trillion in late 2013, China's holdings have since dropped by a combined $500 billion, or almost 40%, in the past 10 years to just a bit above $800 billion now. He continued, the reductions have clearly gathered steam in the past 2 years, likely aggravating the Treasury sell-off. If China loses interest in Treasury securities, it won't be alone. Disinterest in U.S. debt. In recent weeks, Treasury auctions have seen diminishing investor demand, including for 3-, 10-, and 30-year bonds. The subdued interest has resulted from the federal government flooding capital markets with bonds and widespread concern about Washington's fiscal path that many, such as Federal Reserve Chair Jerome Powell, contend is unsustainable. The Treasury issued $1 trillion in bonds in the third quarter and is forecast to flood the market with another $850 billion. The national debt has topped $33.55 trillion, and the federal deficit is close to $2 trillion. That said, there was some good news in the bond market as the $13 billion 20-year Treasury auction on October 18 was met with robust and better-than-expected demand. This offered a reprieve in the sell-off of longer-term Treasury securities. The benchmark 10-year yield crossed the crucial 5% mark on October 19 for the first time since July 2007. While it paired those gains and retreated below 5% again, the yield has rallied by roughly 40 basis points this month. Investors took their cues from Mr. Powell, who told the Economic Club of New York that U.S. monetary policy isn't too restrictive. He said, "Does it feel like policy is too tight right now?" I would have to say no. While he signaled that the central bank might be done raising interest rates, Mr. Powell left the door open for additional tightening if growth and inflation fail to moderate. He said, "Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions." The Fed has shown no indication that it'll resurrect its immense bond-buying program. The central bank is in the middle of reducing its balance sheet, which climbed to an all-time high of $8.9 trillion during the COVID-19 pandemic. Officials are unclear when the Fed could return the balance sheet to pre-pandemic levels, but they've offloaded $1 trillion in the past year. As a result, some believe that it's unlikely the institution could start scooping up Treasury securities again. Don't forget to comment in the section below to share your opinions on today's topic with us. If you find the information helpful, please share this video with a friend to watch together. This will be a great source of motivation for our team to produce more and more quality and reliable videos. And also don't forget to like and subscribe to see more interesting topics from China Truths. Thank you for tuning in.